Welcome to our CFP exam prep discussion on money market securities. Today we're diving deep into these essential short-term investment vehicles that often appear on the exam. Let's break down these crucial instruments that provide liquidity and safety for investors. Let's start with Treasury Bills, often called T-bills, which are the safest money market securities available. T-bills are issued by the U.S. government and typically mature in 4, 13, 26, or 52 weeks. A key concept that many test takers misunderstand is how T-bills are priced. They're sold at a discount from face value, and the difference between the purchase price and face value represents the interest earned. For example, if you buy a $10,000 T-bill for $9,800, your interest earned would be $200 at maturity. Moving on to certificates of deposit, or CDs, which are time deposits issued by banks. One crucial point that often trips up exam takers is the difference between negotiable and non-negotiable CDs. Negotiable CDs can be sold in the secondary market before maturity, while non-negotiable CDs cannot. The minimum denomination for negotiable CDs is typically $100,000, making them primarily institutional investments. A common exam mistake is confusing early withdrawal penalties with secondary market sales. Remember that selling a negotiable CD in the secondary market doesn't trigger an early withdrawal penalty. Commercial paper represents short-term, unsecured corporate debt, typically maturing in 270 days or less. Many test takers struggle with understanding credit risk in commercial paper. While it's generally considered safe, it's not government-backed like T-bills. Commercial paper is often backed by bank lines of credit, which provides additional security. A practical example would be a corporation issuing 90-day commercial paper to finance inventory purchases. When studying for the exam, pay special attention to the yield calculations for these instruments. Money market securities often use different yield calculations, which can be confusing. T-bills use a discount yield, while CDs typically use a simple interest calculation. The exam might ask you to convert between these different yield measures. Another critical concept is liquidity risk. While all these instruments are considered liquid, their liquidity profiles differ. T-bills have the highest liquidity, followed by negotiable CDs, and then commercial paper. The exam often tests your understanding of these relative liquidity differences and their implications for portfolio management. A major mistake students make is not understanding the role of these instruments in a portfolio. Money market securities aren't just about safety. They serve specific functions like cash management, temporary parking of funds, or meeting short-term obligations. The exam might present scenarios where you need to recommend the most appropriate money market security based on a client's specific needs. Interest rate risk is another area where test takers often stumble. Even though these are short-term instruments, they still carry interest rate risk. The shorter the maturity, the lower the interest rate risk. This relationship is particularly important when comparing different money market options. Remember to focus on the credit quality differences among these instruments. T-bills carry virtually no credit risk. Bank CDs are FDIC insured up to certain limits, and commercial paper carries the highest relative credit risk among these options. The exam frequently tests your ability to assess and compare these risk levels in different scenarios. Understanding these distinctions and common pitfalls will help you navigate the CFP exam questions on money market securities more effectively. Focus on the practical applications and remember that the exam tests both your technical knowledge and your ability to apply it in client situations.